Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. In my last video, I promised I would go over how I value companies. Before we begin though, I want to stress that this is how I value companies, and I'm on the same journey as many of you. I'm no expert and don't claim to be. However, I hope that by showing my process, I can help you become a better investor and maybe learn something myself. I'm a big believer in the process. I think every investor should have a process for valuing a company and should not deviate from that process. This assumes that you buy individual stocks in this case though. If you're an investor who doesn't want to get into the whole buying individual companies and keeping up with the news and their earnings, I wouldn't blame you at all. More power to you, and honestly, I think that's probably the best approach. But if you are one of the crazies like me who thinks they can pick individual companies, hold them, and beat the market over the long term on the other hand, before we get into the methods for the crazies like us, I want to throw a huge shout out to Everything Money. Everything Money is a fairly newer YouTube channel that's been making big waves since coming onto the scene. The guys over there developed a software called the 8 Pillars, which you can get access to by joining their Patreon. It's dirt cheap right now too. Before, I used to use Morningstar frequently to do all my evaluations, but I've since switched to the 8 Pillars. It's just so much better to use. Don't get me wrong, I still use Morningstar every so often, but 8 Pillars has definitely become my go-to. Again, be sure to check out the Everything Money YouTube channel, linked in the description below. Alright, enough shilling for other channels, back to our regularly scheduled nonsense. To use an example of how I value individual companies, I'm going to go with Huntington Ingalls Industry, or HII. This company is a military contractor like Lockheed Martin. While I'm not going to go in depth about why I like HII as I did with Lockheed Martin, which you can check by clicking the card in the upper right corner, we're just going to be looking over the numbers for HII. When I value a company to see if it's the right fit for me and my financial goals, the first thing I like to know is the company's market cap. For HII, it's $8.69 billion. The other metric I like to be aware of is the PE ratio, which I'm looking to stand right around 20, just because PE isn't a very reliable metric. Once we know the market cap of the company, we move on to the first important metric, which is revenue growth. Really what I'm looking for is a company that can consistently bring in more money every year, and the answer for HII is yes. Seeing its revenue go from $6.9 billion in 2015 to $9.08 billion in 2020. It is always good finding a company that can consistently bring in more money every year. The second section is shares outstanding and is as important, if not more important, than revenue growth. It's not often that people talk about it, though it really should be. Shares outstanding is a measure of the number of shares held by investors, and if that number is going up or down over time. If the number of shares outstanding is going down, that means the company is doing what are called share buybacks, and your stake in the company is actually increasing even if you don't buy more shares. If the number of shares outstanding is going up, that means you're being diluted, and this is something that we really have to explain. Imagine a bagel, a plain bagel. And this bagel represents a company. You have paid for half of this bagel, and another investor, let's say, owns the other half. So you own 50% of this business, and then the business, for whatever reason, decides that they want to raise cash. And so what do? Well, they go and they issue more shares, which means that your 50% of the business becomes 25% of the business. And if in the future they want to issue more shares, then your stake in the business could go from 25 to 12.5, and from 12.5 to 6.25, depending on how many more shares that they issue. Usually it's not to this extreme, but this example is just to show you what shareholder dilution is like. To show you an extreme example of shareholder dilution, I would like to look at Palantir really quickly. In 2019, they had 905 million shares outstanding. In 2021, the first quarter of 2021, they had 1.8 billion shares outstanding. So if you bought this company in 2019, by 2021, just 2 years later, you now own 50% less of the business than you did when you bought in 2019. This means you have half of the stake of the revenue of the business, even if you still own the same amount of shares that you did in 2019. Shareholder dilution is the silent killer of long-term investing. A lot of large tech companies are guilty of this shareholder dilution because they generally need a lot of cash to power the quick growth of the company. Now, we mentioned before shareholder dilution that companies can also do things called share buybacks. Share buybacks work in the exact opposite way of issuance of shares. The company in question uses the cash generated from their business to buy back shares of the company, therefore increasing your ownership stake in the business. The shares essentially disappear, they're reabsorbed into the business, causing the overall share count to decrease. Looking at HII, the company uses its free cash flow to buy back shares, increasing your share's value. Assuming HII continues this trend, your ownership in the long run will increase. This is definitely something desirable in a company. Share buybacks are a healthy sign of a mature, well-established company with a steady stream of cash. The last thing a company can do is nothing at all with its share count. Simply put, the company can just leave the share count the same, neither issuing nor buying back shares, though most companies don't do this. The next question I ask myself is this: are the total current assets of the company greater than the total current liabilities of the company? If you're not sure what total current assets means, just know that it's a measure of, well, the total current assets a business has. Pretty simple, I think. Some things considered current assets are cash on hand, the total receivables, and the inventory a company has. We use this instead of total assets, which account for land, properties, and deferred assets. We want to look at this instead because in the case that something were to happen to the actual business, the total current assets are a measure of the financial firepower of the company itself. Now we'll compare this to total current liabilities. Don't mix these two up now. Total current liabilities is a measure of the more immediate liabilities that could immediately affect the business. Things like accounts payable or the amount a company like HII owes to vendors and current deferred liabilities. This is contrasted to total liabilities, which would include long-term liabilities like lease obligations and a pension plan, which, by the way, is $1.27 billion. Looking at HII, is the company's total current assets more than its total current liabilities? Our answer is yes, but not by much. Next, we'll want to look at the company's free cash flow, or FCF, the amount of cash a company like HII has left over after all expenses are paid. We've mentioned already that HII is using its FCF to buy back shares and established that this is a sign of a healthy and mature company. The FCF, though, is harder to manipulate than things like net income. That's why I like to look at it for these stats for any company I want to value. We want to see this part increasing, and HII has been. When it comes to free cash flow, we really want to see this increasing. $700 million to $736 million, so not a lot of growth there. Once we've established that a company's FCF is at least growing, we need to find the average in the last 5 years. For HII, that average comes to $505 million. Now, we multiply this average by 20. We use 20 because that's the number that signifies to investors like us what we are willing to pay for $1 of free cash flow. To stay on track, we're not going to get into the very lengthy discussion of how value is calculated this way or what an appropriate multiple for determining it should be. Really, it's just out of the scope of this video. All we want to know is how little possible we can pay for something that will later generate the largest returns. 20, for me, is the max that I'm willing to pay for every $1 of free cash flow. Back to the numbers. If we multiply HII's $505 million by 20, we get $10.1 billion. This is the max we'd be willing to dish out for HII if we stick to our personal rules. Currently, HII's market cap is listed at $8.72 billion, so according to these metrics, HII is undervalued and is financially healthy. When valuing a company, you should also look at return on invested capital, or ORIC. This is a measure of the rate of return that a company earns on its money it invests into its business. Usually you want to see this number as high as possible. Above 10 is ideal. Looking at HII's ROIC on Morningstar this time, according to Morningstar, HII's ROIC score is 21.31. For reference, Apple's ROIC 5-year average is 24.98. What does this mean? A shipbuilding company is as effective at using their money as Apple is, which I just find hilarious. And no, I stand by my statement regardless of the notable size difference between HII and Apple. The last thing I really pay attention to when I value, though, is dividends. If the company you're looking at and researching pays dividends, then it's important to look at the company's quick metrics. For this part, we'll hop on over to Seeking Alpha, link in the description below, and check out the dividend summary section. HII's dividend yield is 2.11%, putting its annual payout at $4.56. This company in particular pays quarterly dividends, so you get roughly $1.14 in dividends per share every quarter. When examining how a company handles dividends, dividend investors in particular should pay close attention to the payout ratio and the 5-year dividend growth rate. The payout ratio is the ratio of free cash flow, FCF, to dividends paid out. We want this number to be as low as possible. HII's payout ratio stands at 35.06%, which is actually a phenomenal number, meaning the company has plenty of room to grow its dividends. Secondly, the 5-year growth rate is the average that the dividend increases at. HII, again, has some great numbers here, standing at a whopping 19.25% 5-year annual growth rate. That means if you invest in HII, assuming they stay the course, the amount of dividends you receive will increase by 20% every year. On top of that, HII has been growing this dividend for 8 consecutive years. With all that said, let's recap. Number 1, find the company's market cap and examine if the revenue is increasing over the last 5 years. Number 2, ask if the company is diluting shareholders, doing nothing, or buying back shares. Number 3, compare the company's total current assets to its total current liabilities, which is greater. Number 4, determine if the company's free cash flow, FCF, has increased in the last 5 years. Number 5, do the math to determine if the company's average free cash flow from the last 5 years multiplied by 20 is greater or less than its current market cap. And number 6 is look at the ROIC, or return on invested capital. We want to see this higher than 10. And then, of course, if the company is paying dividends, to look at the dividend facts and see if they can actually afford to continue to pay their dividend. This is the process I use to get a basic overview of the company's financials. Really the first major part when I value any company. If a company doesn't meet this criteria for me, I won't even consider it. I get that it seems kind of extreme, but I also find it immensely important to view the money side of the business to see if it's even worth investing in over the long term. There are, of course, always going to be exceptions for everyone. Mine happens to be CrowdStrike. If you haven't heard me mention it over and over and over again in other videos, can you tell that I really like the company? But there's more to a company than its financials. There's the company itself to consider. After I look at the company's financials, I want to know more about the company itself. And this is actually the format that I use on my videos about individual companies. I want to determine what sets the company apart, what makes its business model different from others, and if this company can sustain growth over time. This can be one of the hardest parts of investing, though. You have to determine if the company you're investing in is good and can continue on the path it's on, and if you're comfortable with that path or not. Since I used HII as an example for valuing a company, you must think that I'm going to invest in it. After all, HII passes all my metrics, but I'm not going to. Personally, after digging around about HII, I don't believe that HII really has any great growth prospects for the future. I use this process in total, money side and the company itself side, to really allow me to get an upfront view of the company if I want to put my own money into it. For me, I just don't feel it'll benefit me long run to invest in Huntington Ingalls Industries right now. Am I wrong about Huntington Ingalls Industries? Well, maybe, but I'm willing to be wrong. I think it's massively important that a company is financially stable before you consider investing in it. That's why I examine the financials using this process, and then examine the company itself if financials pass the metrics I've outlined in this video. It's also why I generally don't buy companies that would be considered penny stocks or buy any too new companies. They just don't have solid enough footing to warrant me giving them my hard-earned dollars. It's explaining my process in this video that's actually prompted me to drastically reevaluate my portfolio and determine if it's actually keeping in line with my own rules I've set. With all that said, that's all I've got for this video. I hope I could give you some insight into what I think is a good way to evaluate companies, or at least give you an idea how you would value them for yourself. Again, I hope you check out Everything Money and their 8-pillar software. However, hit me up in the comments section below or on my Discord if you have any questions or want an open discussion regarding the valuation process that I use. With that, I hope to see all of you in the next episode of Dollars and Cents.